Hi everyone, welcome to this session of the Tiger Academy, US Stock Financial Statements for Beginners. In our previous session, we covered the asset side of the balance sheet and gained an understanding of current and non-current assets. We also learned about ROA, which measures the returns on assets of a company. In order to avoid investing in companies with liquidity risks, we're going to learn about the liability side of the balance sheet in this session. What are current and non-current liabilities? And how can we use these accounts to access the solvency of a listed company? In short, we can focus on the current and quick ratio delivered from the financial statements. Where these indicators are well below 1, there is a great likelihood that a company has liquidity problems. Now, some of you may ask, but how do I calculate these two indicators? The answer is by looking at current and non-current liabilities on the balance sheet. Current and non-current liabilities are listed under liabilities on a balance sheet. Current liabilities are debts that are due to be repaid within 1 year, and non-current liabilities are debts that are due in more than 1 year. Although many different items can be included in these two categories of liabilities, at Tiger Academy, we think that we mainly need to focus on 4 particular items under current liabilities and 1 item under non-current liabilities. Now, let's take a look at those items in detail. Under current liabilities, we'll focus on 1. Accounts payable. Accounts payable are essentially IOUs. When a company purchases goods or raw materials in this way, it incurs debt. According to the principle of accrual accounting, when a company takes delivery of goods or services and doesn't make immediate payment, a debt is incurred and an entry is recorded under accounts payable on the balance sheet. 2. Accrued expenses. Similar to accounts payable, accrued expenses are debts that have been incurred but not yet paid and can include things like business taxes, employee payrolls, rents, etc. 3. Short-term debt. Short-term debt is debt that a company must repay within 1 year, including items such as commercial paper and short-term bank loans. Companies use short-term debts to finance for its working capital. The best companies generally carry no short-term debt, and such companies have ample short-term cash flow to meet their debt obligations. Healthy companies generally keep short-term debt within 5% of their total current liabilities, since 5% is just a rule of thumb. We should note that certain sectors, such as the financial industry, have a more aggressive financing strategy for leverage. Therefore, companies in these industries tend to have relatively higher short-term borrowings, and we must take these differences into account when analyzing companies. 4. Long-term debt that is due within 1 year. This term means that the long-term debt of a company is due within 1 year, and a sustainable sum will be paid out. If the sum is extraordinarily high, we should be careful. If a company has insufficient short-term funds, it may run into a liquidity squeeze. Under non-current liabilities, we'll look at long-term debt. Long-term debt refers to debt that is due in more than 1 year from the balance sheet date. Now I'm going to share with you a formula used by Warren Buffett. It's the ratio of net profit to long-term debt. Buffett believes that, in any given year, a listed company should have made enough profit to pay off its long-term debt within 3 to 4 years. When judged by this ratio, many exceptional companies look pretty good. For example, Microsoft can pay off its long-term debt with only 1 year of net profit, while Apple's net profit can cover its long-term debt in 2 years. When scouting for worthwhile investment targets, Warren Buffett makes it a rule that a company must be able to pay off its long-term debt with 3 to 4 years of net profit. With this rule, you are one step closer to trading like Buffett. Having covered both current liabilities and non-current liabilities, we can now calculate current ratio and quick ratio. First, let's take a look at how current ratio is calculated. Current ratio is the ratio between current assets and current liabilities. The higher the current ratio, the higher a company's liquidity and the greater its ability to pay off its current liabilities. Generally speaking, a current ratio above 2 is considered excellent, while a current ratio below 1 indicates the possibility that a company may run into a short-term liquidity squeeze. A current ratio above 2 indicates that current assets are at least twice the amount of current liabilities. Even if half of the current assets cannot be quickly converted into cash, a company will still be able to pay off its current liabilities. We particularly view such a company as possessing adequate liquidity. Some of you might ask, is it always better for a company to have a higher current ratio? My answer is not always. There are two possible explanations for an excessively high current ratio: high inventory or high cash position. A high inventory indicates that a company has trouble selling its products, likely due to the lack of the product's competitiveness in the market. On the other hand, high cash position indicates that a company's capital utilization is low and that it is not being operated at its full potential. So, as you can see, there's not one optimal current ratio for all companies, and we shouldn't judge a company's health based on its value alone. Now let's take a look at how to calculate the quick ratio. The quick ratio is the ratio of quick assets to current liabilities. The quick ratio is a measure of a company's ability to quickly turn current assets into cash to pay off debt. Quick assets equal current assets less inventory and other current assets. A company's quick ratio is, in turn, the ratio between its quick assets and its current liabilities. The good news is that you don't have to calculate these ratios yourself. Just enter the stock code into your personal Tiger Trade app, find Company and click Details. Then select Financial Analysis to view both the current and quick ratios. So, now that we know what a quick ratio is, how can we use it? Normally, a quick ratio of 1 or above is optimal, which means that every $1 of current liability is readily covered by at least $1 of liquid assets. A quick ratio below 1 demonstrates that a company may run into a short-term liquidity squeeze. On the other hand, while a quick ratio above 1 shows ample cash flow, it can also be an indicator of poor cash management. A higher quick ratio is not always better. We need to analyze it on a case-by-case basis while considering the nature of the target company's industry. For example, the retail sector trades goods for cash directly and has almost no accounts receivable. Consequently, it's reasonable to have a current ratio far below 1 in the retail sector. On the other hand, although the quick ratio of a company may be greater than 1, the majority of its quick assets may be accounts receivable. In this case, despite the quick ratio, whether or not the company is ready to receive its debt could be dependent on its liability to collect the accounts receivable quickly. Consequently, we should evaluate the quick ratio in the context of the company's realistic ability to turn over its accounts receivable. Quite easy so far, right? Now, with the knowledge of these two ratios, you can judge a company's likelihood of defaulting. Now, let's summarize. The current ratio and the quick ratio are two important metrics to help you access the liquidity of a company. With these two ratios, we can quickly tell whether a company is likely to default. So far, we have covered the assets and the liabilities portions of a balance sheet. In the next session, we'll move on to the study of shareholder equity, also known as net assets. These will help us better access the profitability of a company. Are you ready? See you in the next class.